This is chapter 7 in video 2. Let's launch. So for today's learning objective, we're going to go ahead and calculate the tax consequences associated with the disposition of capital assets, including the netting process for calculating capital gains and losses, calculate the deduction for investment interest expense. All right, so portfolio income, capital gains, losses. So if you have investments that are held for appreciation potential, and they give you a couple examples here, growth stocks, land, mutual funds, blah, blah, blah. These get taxed in various methods, and so we have to examine how these kind of guys get taxed, and as a result of the taxable treatment of these, they're going to get taxed in different ways. For example, stocks generally are going to be capital gains rates if they're held for a year or more, if they're held for more than a year. Land, same thing. Mutual funds, pretty much same thing. Other assets, so precious metal collectibles, could be taxed at the collectibles rate, which is 28% flat rate, but that's going to be dependent upon if they meet the criteria. So investments held for appreciation potential, gains are deferred for tax purposes until it's sold. I know that when I know you audit buffs, and you know why you want to be auditors is beyond me. You should be tax people. Tax is cool. Okay. But if you want to be auditors, you know, one of the things that you're going to say is that, hey, every year I got to do a revaluation mark to market in order to do trading securities. That's not how it works in tax. And actually I think it's a good thing, because if that ended up happening, a lot of clients would be very unhappy. But gains are always deferred for tax purposes until you actually sell it. And that's a concept that has never changed over the years that I've ever done this. They are generally taxed at preferential rates when they meet the qualifications of long-term assets. Long-term assets being held for more than 1 year. Specialty loss rules do apply. For example, wash sales. So if you sell an asset at a loss and then you buy it later on, that loss gets denied, and that's very important to know also. These types of investments are generally called capital assets. From an individual standpoint, definitely, and from a business standpoint also. So capital asset is any asset other than asset used in trade or business, accounts receivable, and inventory. We've already talked about that in a previous video. I won't delineate on that too much more. Sale of a capital asset generally generates capital gains and losses. Now, I've actually had some times where I've worked with clients that we've looked at this very seriously. Specific identification versus FIFO. So generally speaking, when you do, so say for example, I buy 1,000 shares of IBM, then I buy another 1,000 shares of IBM, and I buy another 1,000 shares of IBM, and I buy another 1,000 shares of IBM, and I turn around and sell 2,000 shares of IBM. Which ones have I sold? Okay. Generally speaking, you're going to do FIFO. So the 1,000 shares of IBM that I bought earlier are going to be deemed disposed of. The other 2,000 that I had already bought will stay with me, and then I get paid capital gains on the FIFO'd ones that I sell. However, the IRS does allow you to do specific identification, and this can save your taxpayers a lot of money, especially if they had to sell these stocks and they weren't ready for them. So, for example, if they sold these stocks because they needed cash immediately for a family emergency, maybe they don't have the cash in order to be able to pay taxes. You can go to specific identification. Maybe they bought it. 10 years ago, they bought 1,000 shares. 8 years ago, they bought another 1,000 shares. 6 years ago, they bought another 1,000 shares. And then they bought the other 1,000 shares within the past 30 days before they sold this other stuff. You can go back to specific identification. You might actually save them an exorbitant amount of taxes at the time. Now, it's a deferred tax savings, because when they sell those other 2,000 shares, they're going to pay the tax anyways. But it might be something that's very helpful for you. And the IRS does allow you to do this, and so it's important. Capital asset, again, held for 1 year or more than 1 year. It's long-term if held for more than 1 year. Short-term is 1 year or less. I repeat, long-term is more than 1 year. Short-term is 1 year or less. You may want to know that. So capital gains, like I said, you're going to net the short-term capital gains that are going to be taxed at ordinary rates. Net capital gains are taxed at for long-term gains are if they're in excess of short-term gains or short-term losses. They're going to be taxed at a preferential rate of 0, 15, or 20%, depending on their filing status and income. We'll talk about that at Exhibit 7.3. Certain gains from sales of depreciable real estate held long-term are taxed at a maximum rate of 25%. That's your 1250 gain. We'll talk about that a lot in Chapter 11. Long-term capital gains from collectibles and qualified small business stock are taxed at a max rate of 28%. Now, what's a collectible? So a very good example, art, precious gems, jewelry. Those are going to be considered collectibles, and they're going to be subject to different tax rates. All right, capital losses. You're allowed to deduct up to $3,000 unless you are married filing separate. Then you are going to have to deduct you're only going to be allowed to deduct up to $1,500. And then the remainder of it's going to carry forward for the rest of, forward indefinitely. I did have one time where I was working on a client. I think they were 60 years old, and they had something like $400,000 in capital loss carryovers. And they were like, well, we got to take $3,000 because my wife won't let me invest in the stock market anymore. I was like, yeah, if I lost $400,000, I think my wife would have done the same thing. But if you think about it, actually it was not a smart move. Put money back in the market, let it earn some money off of you if you invest smartly, and then you can go against those capital losses. Don't pay any taxes on it. I think that would have been a better conversation to have. Unfortunately, the partner who was in charge of the account didn't do that. So it is what it is. All right, so this is the capital gains and losses netting process. So I'm not going to read this. I want you guys to understand this. I'm trying to think if there's anything here that, this is a pretty logical, rational process. Now, something you're going to learn about this class. So we just finished section 1 of the class where we talked about individuals. We're now talking about property transactions, okay? Property transactions are much more mechanical and straightforward than I would say individual tax returns. Individual tax returns, you had tax deduction over here. Yeah, why'd they change this law? Why'd they do this? Why'd they set things up this way? Blah, 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 so on and so forth. It doesn't make any sense. I would say property transactions and corporate transactions are far more straightforward than you're going to find in the individual realm. And that's one reason why there's a lot of people who decide, I don't want to go into individual taxes. I want to do corporate taxes because it makes more sense. But there are some areas that kind of takes place. This is a very mechanical test. And again, you're gonna do these tests every time you got to do the netting. And I know there's going to be a question on this on the test. So you might want to make sure that you've hit that. So the limitation on capital loss deduction, special rules apply for personal use assets. Yes. So if you buy a car and you sell the car at a loss, there's no tax deduction. If you buy a car and you sell a car for a gain, taxable. Now you might say, why the heck is that? And again, this is where I'm not the tax god. I don't make the rules. This is the rules that the IRS came up with. Is there any logic to it? In my opinion, no. But I could also imagine that if you say, for example, you buy a car and you sell it, several years later, you're probably, you're going to try and track it down. It's going to be a huge audit mess. I can imagine why the IRS would have done this. But does it fit tax theory? My personal opinion, no, but it is what it is. Again, poker player here. I play the cards I'm dealt, not the cards I want. Capital losses from sales to related parties are not deductible currently. In other words, the related party may eventually be able to deduct all or a portion of them of the disallowed loss in the subsequent year. So if I sell my land, say I buy my land for $100,000, I sell it to my brother for $50,000. That's a $50,000 loss. IRS is not going to allow me to take a deduction. The reason why they're going to say it is, how do we know it was at arm's length? Okay. And they're not even putting in a provision here for fair market value. They're just saying you can't deduct this. Okay. And so you have to deal with it. So, what happens is the related party will take the losses, not you. This is where I think that with our clients, we work really hard in order to make sure that they get the advice that they need at the time. I've had words where they've said, hey, I want to sell this property to my brother. Can I do this and get away with it? And we looked at it and looked at the transaction. No, you're going to have a related party loss. You don't get a loss off of it. But the value of the land is decreased. Why can't I just sell it to my family member and be done with it? IRS doesn't allow it. They don't care about facts and circumstances on this one. It's pretty mechanical in this sense. All right, wash sales. This is something you may deal with quite a bit. between you, me, and the fly in the wall, 99 times out of 100 that you deal with this, you're not going to deal with the wash loss because you're looking for one. It's going to be reported on a 1099 consolidated or a 1099B, which is the statement that's used by brokers to show you gains and losses on sales of stocks and bonds. And they're going to tell you the wash sale codes, and 99 times out of 100, you're not even going to calculate this, but it is important to know the theory behind it. Why do we have this sort of thing that happens here? Well, the reason for it is that if you sell an asset and then buy it back within 30 days, the IRS kind of feels that, this prevents loss harvesting on a grand scale. Okay, so if you think about it, you get to the end of the year, you notice all these stocks have losses. You like the stocks, you want to keep the stocks, but you need a capital loss to write against your own tax return. So you go ahead and you sell these stocks and you buy them back 15 days later. Have you really recognized a loss? The answer is no. You still own the stock. Now, the 30 days before, 30 days after the sale, the day of the sale, all that stuff, it's a 61-day period. Between you and me, I think it's very arbitrary, but that's what the IRS chose. So we kind of go with it. Okay. So it's a very arbitrary thing. We go with it and we deal with it. All right. So that's like I said, cards I got, not cards I want. Okay. That's how we poker players work. Okay. So it's intended to ensure that taxpayers cannot deduct losses while essentially continuing on their investment. That's the party line. And that's kind of what we go with on that. Tax planning strategies. You can hold assets for more than a year and then sell them. That will actually reduce your taxes significantly, particularly for your very high net worth individuals. Loss harvesting. So if I get to the end of the year and I'm looking and I'm an investor and I'm looking at my sheet and I'm like, hey, you know what? I kind of come to the realization that I'm going to owe a lot of money this year. This happened in 2019, actually quite a bit. People got to the end, up $300,000. They know they're going to get tax hit. In December, you meet with your broker. I want you to dispose of these losses that we have here. They're obviously not doing any good. Take the losses right now so I don't have to pay as much in taxes on this. That's what's called loss harvesting. That is, good brokers will do this. Now, it also depends on the good broker. If the good broker is really good, he doesn't have any losses, or she doesn't have any losses. And as a result of which, guess what? There's nothing to offset on it. So you could run into a situation where you can't even do this because you don't have the ability to do it. Is what it is. You move on and life is good. Okay. Must balance tax with non-tax factors. So here's the thing. In 2018, we had a very bad year. Stocks went kind of, it melted. Darth Vader came and melted our brains, melted the stock market. Okay. That's kind of what happened. I'm sorry. That was a Back to the Future reference, by the way, for anybody who's watched Back to the Future. But what happened to the stock market in 2018? It went down and hard. Okay. What happens when stocks go down? What's the first thing your instinct is? Sell. Okay. I want to sell now, sell now. And if your financial planner was worth their weight in gold, they would do everything in their power to hold you to this and say, stand by, it's going to go. Because if you take a look at the stock market as it went down in 2008, and then over like the next 2 or 3 years, it went right back up to where it was. And if you just stayed put, you did fine. But if you panicked, you sold. So a lot of brokers, when you call them up and say, oh my God, and then we had this happen with COVID. Stock market took a plunge. Everybody wanted to get out of the market. I was probably one of the few people that had extra cash nearby, and I said, let's get in the market. And it was funny. I called the stockbroker up. He's like, man, you're like one of the few people that's saying this right now, but it's smart. Let's do it. And we did. And so far, it's been a great ride. I think we're up 20% this year, in that particular investment pool. So, passions are going to hit. And here's the problem. If the stockbroker refuses to pull the person out, they're going to be mad because they're going to think the stockbroker's trying to hold their feet, blah, 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 so on and so forth. We have to also tell our clients that, hey, look, my recommendation is listen to what your professional does. And personally, now, of course, if the person's making bad advice, it's one thing, but it is not our place to give them financial advice but they need to follow the financial advice of the person who's giving it to them. But that means sometimes they're going to come to you and they're going to say, I'm selling all this stuff because I'm losing my shirt. What's going to be my tax effect of this? And I'm kind of thinking to myself, don't worry about the tax. Do what your professional tells you to do. That's more important than anything else, because we can handle the rest of that. Okay. So it's very important that we do those things and set those things up right. So investment expenses are used these are no longer deductible. Okay. From a tax perspective. So if you have investment expenses, unless they get added into the basis of the stock, they're not going to be deductible. And as a result of that, we need to be careful about that sort of thing. Okay. So in that case, we need to kind of take a look at that. And clients are going to come to us and ask us about this all the time. And it's not deductible anymore. There's nothing we can do. That's temporary as part, and we talked about that in the deductions video. It's a temporary reduction in deductions that were allowed under the 2017 Tax Cuts and Jobs Act. Investment interest is an exception, though. This is still deductible. So margin interest, if you take a look at the 1099-B and you get the 1099-B in front of you and you're looking at it and you go through and you see margin interest is very deductible. And that's good. That's a good deduction, because there's a lot of CPAs that I've seen in the past that'll miss that. So if you can catch it and you can use it, it's going to be a good deal for you. It's going to be a good deal for your client. Interest on loans to acquire investments, deductible is an itemized deduction. Yes, it is. It is limited to investment income. So if you're not making a lot of investment income, but you're making a lot of investment expenses, does that mean I don't record it? No, you do record it. If you do record it, it carries forward indefinitely. So you want to record that so that later on they get the deduction. If they can't take it immediately, it's actually good for them and all. All right, folks. So that's all I got to say about that. I want to say thank you very much for coming to class, and I hope to see you in the next class.